Thanks to American Federal Bank, we're back with another episode. What are we talking about today, John?
We're definitely going to fit wheat, corn, and beans in there. I have been talking about it, the wheat corn spread for sure. Now, the most important thing is, what decisions are you making this time of year for your corn and soybeans and options and storage and that mix? If you do it right, there might be light at the end of the tunnel. We're going to go over that and try to come up with some answers for the storage situation in harvest and using options.
Let's go.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we have some actual fall weather, cold, rainy today. I kind of want to just chill out and sit by a fireplace with a book, but I guess we'll talk commodities.
Well, I've been fishing to avoid the markets. I think everybody's doing what they can to avoid the markets. Of course, if you go on Twitter, you'll see people killing it in the markets. But I think that's stock market. It goes up every day. Of course, you're killing it.
Yeah, that or cattle.
Cattle's killing people. Hedgers. It's that we'll definitely cover that today. That is a market that we need to talk about.
The one stat I saw today, thanks to MSG Capital on X, was he does a closing volatility run every day, mainly for soybeans, but X soybeans at 12.9%, March soybeans 14.4% for volatility, and the one that really stood out to me, corn. December corn, 16.8% on the volatility. That is low.
Yeah, which means the options are very, very cheap, which also means their modeling shows the stuff not moving at all. Of course, the options can be wrong, but they're, look at the straddle we talked about. I actually had a client call and was kicking the tires on selling something like that in a straddle. 30 cents in March, 29. I've seen 20 trade 29. So you buy a put and a call. It doesn't matter what direction it goes at all.
Or sell them. In this case, he was
talking about selling. He was asking about it. And he didn't realize the volatility, the implied volatility, basically what they think it's going to move in a given time period is, and it's, not record lows, but I looked at the chart. I put it out on Twitter. We're the lowest since 2020 in July for soybean volatility. So the action's draining out of these markets. Just when you think it can't get worse, it's draining out of these markets. Now, we have the tweets that make it go all over the place, but even that now is starting not to work. Or was it ever working?
Even the tweet moves, though, aren't like they were in 2020.
No.
In 2020, you could guess a tweet might be coming and you wouldn't know which way maybe, but it was going to move the market.
Yep.
It's 10 cents now. I mean, in beans.
And we just had one 10 minutes ago about China and cooking oil. We're not going to buy it from them because he thinks that they're targeting soybeans, specifically not buying from us. So we're going to start targeting them back. It doesn't sound like a trade deal's near. But the problem you have with your shorts is that if you get the right tweet or you get something going on, then all of a sudden you don't want to be short here. And I think that's where the funds are. This could be worse, believe it or not. They're not picking on these markets at all. The funds are, if they're short corn, they're short very little. And beans, I think they're net long. So I think that they're just scared to short it at these prices at this time of year. And then a tweet could change everything. But the longer this carries on, the less it's going to move markets until you see actual substance. In the meantime, this is death by 1,000 paper cuts. I mean, it's not good. And what is there to talk about? Everything's really cheap. So for my mind is how do you apply this profitably to your hedges? What can you do for your hedges? If it's so cheap, can we use this to our advantage? And I think that's really where your concentration should be. It shouldn't be anger that the USDA's prices aren't right, or it's rigged, or this is way underpriced. It is what it is, and it's not going to change anytime soon. So is there anything we can use in the options that helps? And there is. I mean, what do you look at? Do you like corn or beans better for options? And then what's their use in your
Right. I mean, for trading, just from a speculation side, I love bean options, but sure, they're cheap. But what do you buy? I mean, are you buying put? I am eyeing up Strangles at this point because I don't know what it's going to do, but I don't think it's worth money because I also don't think that the volatility's wrong.
Yeah.
I just don't think there's that much move right now. So it really is keep your powder dry. Sit on your hands and wait for something. I do think if there's going to be a move one way or another, eventually it is going to actually move and will trend for a little bit, but I don't think it's in the next month.
Yeah, I'm not interested until the stuff gets put away and the door shut. Now, I'm hearing a lot more soybeans stored than normal, which does that mean corn's going to get weak now because there's no place to put the corn? Is it even true? I think I've heard it enough times that it is true. Guys want to store these beans. And I think it goes back to, I keep saying it's 81 million acres. If there was ever a year to try to store beans for a higher price, it's on 81 million acres. Unfortunately, the backdrop is really bad with China and them not buying, and that's a big deal. But still, if there was ever a year, this is the year. And we're unsure on the yield. And I think guys are doing that. They don't want to. But I looked at the numbers for beans. It's more than 5 cents a month for an option, where corn is 3.5 or 3.25 cents a month. So you're much better off getting rid of your corn if you can, basis dependent, and then just own a corn call. Than you are, but storing beans isn't all easy either. I mean, you lose some. And it's just not the same number going in as it is coming out. So that's why guys don't like to store beans.
The other problem with beans is that the farther out you go, it just doesn't look good to store them out to July right now.
Unless you're going to sell the carry and settle for that price, it's hard to do. But you're storing them for that home run that something's going to change, and all of a sudden you're going to be looking really smart for storing soybeans. That's what's happening right now, guys. Think that could happen. Of course, nobody knows. I'm not going to sit here and say I know that that's a bad idea or a good idea. But if there was ever a year to go for it, it's this year. Because what are you going to store? Your oats? That's in the 2. How about 472 Kansas wheat? How does that look for storing? I mean, there's not a lot of good news out there in storage. And then a corn is just purely, I'm going to store it and hope something happens that I couldn't possibly foresee happening. It's not even like they have 81 million acres or low acreage. They're hoping for way lower yield, way better demand than we already know. Like, you're really looking for something in corn, but they also don't want to sell at this price. That's easy to see why they'd want to store corn. Could we have another down leg? Absolutely. Till we find a home for this, I'm not confident. Now, the one thing I'm excited about is I do have something for new crop corn. And it's a plan that I think is going to work really good, and it involves the cheap options. We're gonna use that to our advantage, and then try to plan for better sales in 26. Because what I think is going to happen is that you will get rallies, but they're going to be short-lived and they're going to be confusing. Like, let's just say we bump up the ethanol, year-round usage, 1%. Like, that's a big, huge bump in corn price, but is it going to stay there? Probably not. So I'm going to start planning for when the price surges, we can sell all the 26 that we want to sell, but we're going to have the upside open as well. And that's where I think a lot of guys that I've been talking with or I'm hearing a lot of this. I'm going to sell 26. I'm going to sell 27. Terrible time of year to do it. I love the carry. I love the thinking like they're playing defense. I'm just going to plant it in 460, maybe try to build a better price. But what I don't like to hear is this happening in a big cluster, because this is usually how everybody gets marketed at a low price, and you don't give your chance for that higher price. You just lock it in. But I can't you fault the guy for playing defense either. But I think where it's going to separate the guys that do better than other guys is the guys that are able to lock a price in and leave the upside open. You're going to give up a little something, or you're going to take a little more risk for that. But I really believe if you're going to have this price or you want this price, you have to have that upside open too. And I think the guys that combine that are going to do a lot better than the guys that just grab a price because it's free, in their mind, like I don't have any risk. I can just get that price. I'm going to get that price and I'm going to try to do a lot better too. If the market goes to better prices in unpredictable time periods, I don't want to be locking away that price or locking in that price when I haven't seen the South American weather or our weather. I hate giving up on that, but I see the fear for next year. I mean, I get it, but that's what we do. We're looking to improve vastly on that, or at least have that upside open instead of just locking in that price and walking away. So call us for details on that. I just think that's where it's going to start separating people, is better marketing decisions this time of year. And then it'll help you further on down the road. I think we're entering that window where these ideas that we have now could really help later on, or at least I hope we're not downtrending all the way into spring. That would be terrible.
That would not be good. Let's jump back to that straddle, though. I mean, you're talking the March, what was it, 430?
430, and that's basically where the futures are, I think, more or less. That's why I'm using that number.
But 30 cents to buy that straddle, I mean, give the mechanics of that. Okay. Especially, do you want to talk storage from that side? Is that a play that you would look at versus storage, or are you just looking at maybe a call, like sell the corn and
the guy
buy a call, or what do you like? Give me some.
The guy's mechanics. Not even wrong. If you're range bound and you expect to be, you sell a straddle or strangle if you think it's going to be range bound, and that part's right. It appears that it's range bound. The problem is you have more risk doing that than anything. So the idea is the guy would sell that, sit on the corn, and then collect that premium 30 cents, which normally would probably be closer to 50 cents. Collect that premium if it stays in that range, or it stays in that 50 cent range between that number you sold. Now, if you sell a strangle, which sounds like what a straddle should be, strangle is going to be two different strike prices instead of the same one. And that's genuinely selling the range. Like you're selling a 520 and you're selling you don't think it's going below 410 and collecting 25 cents for that. Even though that's not the right numbers, that's the idea behind
today,
it.
You're probably collecting 10 cents.
Yeah. You're looking to, if you're just going to sit there in storage, how can I generate revenue on this? So it's a strategy like that. And on the speculation side, if you think it's going to be range bound, while the volatility burns off and just sits still, I'm going to collect that premium. That's why it's dangerous, because there's very little there. So should I buy them? Is the next question. Is there anything there if I buy them? What your bet is, and this is really simple, is that it doesn't matter what direction. And this is why it's really appealing to a lot of guys. They don't know anything about this. And if they do, they might be a little confused. You don't need to know the direction. And that's a big help in commodities. What you're betting on is volatility picking up, and it's going to break out of a range of 30 cents in, what was that, 100 and some days, third Friday in February. So your bet is that somewhere along the way, we're moving more than 30 cents. Either direction, doesn't matter. And it doesn't even need to move 30 cents as long as it starts to move more now or faster, or something changes where volatility goes up. Like it could be the exact same price. You bought it 2 weeks from now and be worth 5 cents more if volatility picks up, or the implied volatility picks up.
I got news for you on volatility direction, though.
That hasn't been the way it's been going.
It's been going down.
A certain thing out of China would do it. Like maybe a Trump tweet's not going to do it anymore. Maybe it's going to be China that says that that they're maybe going to work with the U.S. on corn purchases as well. That would change it a great deal. You need something, or this is another thing, that March window has South America weather in it. So do we look at soybean straddles or strangles? Because, if the weather's perfect, it could sink a lot and China's still out in the market. But if it's not, is it going to go up a lot? And what do those cost? I think there were 51 cents. I think last we checked, or what was it? It was something like that.
Sounds like 58 cents reminds me, but I can look it up while you go down the road of.
What I don't like is the put side of this stuff. Like, once this gets put away, it's unlikely to fall a lot from here, so I don't like that, but I still like the idea that it really just needs to move not much either direction. and it would make a lot of money. It would be better if corn was higher. If we were $5, it might be perfect to buy that straddle. So round and round we go. Like, we're looking for ideas. Guys are looking for ideas. What you don't want to do is get bored and sell something underpriced like this straddle. Even though it might end up working, you got to be careful. And you said it earlier, this really appears to be a time period where you're trying to keep the powder dry and looking for that opportunity.
So the bean straddle, March beans closed at 10.39 today. So the 1040 straddle is 70 cents.
Okay, so
that's
so
a
35.
spendy buy.
It is in the situation when that's why storing beans, like, you can buy a call, but it's like, even though the volatility is way down, still it's cheaper to pay 5 cents a month storage. Just, if you're just comparing the pure price, is that cheap? What do you say? 35 cents on both sides?
Yeah.
It's unlikely to break a 70-cent range till something changes. And that I prefer the corn one actually over that one.
I would agree from that side.
But I'm not buying either of them. It works for years that the yield's in question, where the yield could change a bunch and it could move a lot, up or down.
Yeah.
No one expects that, and that's why it's priced the way it is. But commodities do change, and it will be mispriced. Like, at one point, it's going to look way too cheap. But what also, what bothered me is, like, okay, so if these are really cheap, let's go out of the money a little bit and buy some lottery tickets for the summer, which is never a bad strategy. I like that because it allows you to market, and still have those calls on. But what's funny is they don't go down a lot in value at all. Like, I'm thinking I'm going to get 490s for nothing. And no, actually, it's cheap right at the money, and it doesn't get a lot cheaper as you go out of the money. Surprisingly,
really doesn't.
Those are solid, and they aren't a good deal.
So I will say, I was just digging deeper here. I could see doing a strangle in beans, in the March beans. Like, the 1080 is 20 cents and the 1010 is 20 cents.
Yeah.
40 cents. You're still, now you're talking like an 80-cent range, kind of.
Yeah, what month was that?
That's March.
You got South American weather.
Do something there.
Yeah, you have South American weather.
That I like better than doing the 70-cent straddle. But I mean, so there's options out there. But I agree with you. Like, I've been looking at July calls. I know you hate the July bean calls, but for time wise. But man, you got to get. You're out at $12 before you get under 20 cents, which to me is crazy.
And we're talking about all this stuff. Is anybody actually doing any stuff? No, we're just talking about it. What I think's happening is guys don't like this market, and they're very busy harvesting right now, and they're not thinking about it. They don't want to think about these markets until they have to. I'm not getting the warm fuzzies and the excitement and the phone calls that you would normally get. And I think that's across the country. It's not just guys I'm talking to. They don't like the outlook. They know what's going on. They're well versed in South America now, and it feels like everyone knows, like, this isn't a good situation and it's unlikely to get resolved fast. And that's what I really miss. It has felt like this in the past to some degree, but it's like there's always an out of something. And this year there is. It's 81 million acres of beans. It's like we got a bull in the bunch. But, now there's not enough world demand for it, or there's oversupply to where even the bull in the bunch isn't bullish. And that's really what's hurting. You know what I mean? It's allowing wheat to go down every day. There just isn't anything to hang your hat on. And that's really what's missing is if wheat and corn are bearish, beans would be bullish. If beans were really bearish because of all the acreage, well, that would mean corn could be bullish right around the corner. Wheat is just slowly sinking into oblivion. There isn't anything besides the Russian-Ukrainian war that really has flared that thing up. And if there has, it's been very fleeting. And it's, is that the canary in the coal mine? Is that what beans and corn are going to look like in a number of years? This happened in wheat and it didn't recover. That's what's scary, is what's happening in beans and corn did actually happen in wheat, where we lost that world market. They grow it in a lot more spots. They grew better quality wheat. And now we don't have that export market that we used to have. And that's why acres are down, lowest in 115 years. So is this happening in beans and corn? I don't know. Is the government going to solve it? And that's unfortunately what we're back on our heels in, and we're hoping for that they have a plan, because it just seems like everything's in a bad spot. And then you get the energy's not moving, and you have, literally no energy in the market. It's so odd that you have this in commodities, but there is one market that is moving that has a little too much energy.
Yeah, let's dive into the cattle, because man, it's every time you think it's going down, it does not.
What's unusual about this move in cattle is it felt the need to get very far ahead of cash, including in feeders. Now feeders are coming up fast. The bubble that we have going on in cattle right now is in feeders, and what's happening is in the sale barn, if you buy cattle, it's working. It doesn't matter what you do. Like, it works. Like, everyone tells you it's not going to work. I should have bought more cattle is what happens 3 weeks from then. And so every time you buy cattle, you're rewarded. It's just like training a dog with a treat. Like, I'm not calling guys buying the cattle dogs, but I'm just saying it's rewarding, and you develop that habit. So all the analysts and everyone's going to say, don't buy them. And then every time I do, it works, and you get rewarded. So it's feeding on itself now. You're watching the feeders leave live cattle in the dust. Ultimately, you have to come out on that animal. You have to put feed in it and then finish it for a profit. And those numbers are so far out the window now that it's not even funny. We have cheap feed. We have Brazilian tariffs. We have the Mexican border closed because of the screw worm. We have about as good a story as you could possibly get. We had rain, and there's a lot of hay everywhere. It's not going to get better than this. Now, the real top in cattle is going to come at the consumer level, and it felt like we got there. It felt like we hit 245 live cattle. Felt like box beef hit the levels they hit, and then everything backed off a lot. And box beef really hasn't recovered over the last 2-week fall.
A lot is kind of excessive. It backed off some.
It backed off. The box
backed off a little bit.
About 4, 5, 6 huge days down, and it really hasn't recovered. But the futures just said, hey, we're going to leave that in the rearview mirror. This is going to stay wildly bullish, and we're going to price that in. So that's the phase we're in right now. I don't know if it's a blow off. I don't know if it's irrational exuberance. That would be a phrase that was coined in the or used at least in the tech bubble. We're getting there in the sale barns and cattle, though. At what point do they want to just hit 4? Do they want to go to 450? We're going to have to find that price where it's so far out of whack. Even the guys that are beyond brave buying them at these prices will balk at these prices, or the consumer is going to say that's enough on the box beef. And I think we're already kind of there. And I don't know anybody that's buying $50 steaks in the restaurants anymore unless they know it's going to be a good steak. You're going to start losing segments of demand, and we're probably very close to that, if not there. In other words, are we at $6 corn, or are we at $7 corn for cattle right now? I don't know, $6.50. I have no idea. We're going to get to that $7 corn price where it's just not useful for anything. But nobody knows what it is. It's accelerating. It's a very dangerous market. I wish all the people luck in the hedgers. It's just no one's seen anything like this. I can tell you I know exactly where it's going to go, and that would be a lie. No one knows, but it's really accelerated, and it's gotten very far ahead of cash in live cattle. And every day that passes, this continues to happen. It'll just become more and more dangerous till one day it'll be over. Just keep your head on a swivel there, and it's got to get to a price where people don't want it in the sale barn or on the retail side, and I think we got to be close in both sides.
I will say what did work is your October-December cattle spread.
Or buy cattle, sell wheat, even though it was a joke. That was printing money. And that was after it had moved substantially. It moved a lot more after that.
Yeah. Speaking of wheat, let's jump in. You had mentioned earlier to me that you wanted to talk classes of wheat and the wheat corn spread, and we haven't hit either of those.
Well, so. And back to the cattle, I should have took the compliment back to yes, all the bear spreads in cattle that we were talking about did work. The Jan March feeders and any of the stuff that we talked about in the insider, all of it worked. That's the one thing that has worked in cattle is the bear spreads. But quickly on to the wheat corn. As if it wasn't bad enough news for corn the way it was, it's really expensive relative to wheat. How expensive? pretty much the most in 20 years. 2012, the drought year of corn, was the only time that I saw that it was more expensive. I'll have to see 2007, right at that 19-year mark, might have been about the same price as it is right now. In other words, either wheat's way too cheap, and that sure doesn't look like wheat thinks that, or corn's way too expensive. And even if you don't agree with that and you don't think it is, what's going to happen is it's a feed relationship. It's the wheat's going to make it into the feed channels at this price without a doubt. So Chicago wheat's really cheap relative to corn, but then Kansas is 13 cents under Chicago. So the Kansas wheat down south where it would go a lot in the feedlots or just get fed out of, grazed out of the field, that's going to happen at this price. So wheat's really cheap feed versus corn. I am looking at stuff there, possibly doing stuff. Call me on details for that. And then you also have, I mentioned it, Kansas, a higher quality wheat under the price of Chicago wheat. That's also something that I'm tracking. That's a spread I like, and we're getting to a time frame that generally it works in. There's years where Kansas has gone 90 cents under Chicago. And you know what stopped that market is you can deliver Kansas wheat because it's a higher quality wheat. It meets the Chicago specs. They truck that Kansas wheat to Chicago for delivery for 65 cents. Cost a lot to get it there, but there was a 90-cent difference. And there you go. You got a free, do the math there, 25 cents free for delivering it there. And they did. And that's really what bottomed that spread a number of years ago. But it was already towards 90 cents this time of year. So usually you find your lows, Kansas versus Chicago this time of year. And what makes the spread work is, first of all, it's a higher protein wheat. It should carry a premium. The second part is generally Kansas has more weather problems than Chicago. Planting it, winter, and then especially coming out of winter. It's planted from Texas all the way up to North Dakota, and it's generally drier in those areas than it is in the Ohio Valley where most of the Chicago wheat's grown. And so that's why that spread has it more often than not works. Definitely on my radar screen. I put it out on Twitter too. Something we're watching. You're going to have to be very creative in this market and be nimble, for ideas that you might not be comfortable with if you're going to want to get involved in anything, because you just simply have markets that aren't moving that much, and the ones that are incredibly dangerous. No one wants to buy cattle up here, but obviously selling's not working. So it's not creating this opportunity that you normally see in commodities. Other guys will argue there's opportunity, but I meant call me. Tell me where those opportunities are. I'm not seeing easy markets. I'm not seeing markets that I want to get involved in a lot. But there is a few things we're watching, and it does change, and it will change again. But I don't like this feeling that we have in grains right now. It's really dark cloud hanging over the market, and it doesn't feel like it's going to go away anytime soon. Just had another Trump tweet talk about banning China cooking oil coming here, if they don't play nice on the soybeans. So hopefully something does change. There's a lot of talk, a lot of rumbling, and you can tell people are upset. So usually the politicians start acting. But it's kind of sad, that's what we're hoping for. That's what we're waiting for. And if not, send me a check. And it's just not a good feeling in ag right now. And that's where we're trading. That's where we're at.
Well, let's go on that bright note over to the American Federal Financial Minute. What are you seeing?
Yes.
Interest rates, dollar.
Yes, we have to thank our sponsors here. It's like when you look at the stock market, it was clearly worried about Friday and a full-blown trade war restarting with China. And rightfully so, it was down 1,100 points. And of course, like clockwork, things changed over the weekend. It was everybody softened their stance from China to Trump. And then the stock market was up a bunch. And then they tweeted out what I just said, a little bit ago, and then it's come off. So it's almost back up to the highs. But you look at the numbers, they don't look good. Credit card debt, auto delinquency payments, stuff like that is starting to really look bad. Also, HELOC loans just soaring. You can tell people are struggling with this inflation. The argument is we need to lower rates because jobs are softening, and we need to get ahead of this thing. And the argument is inflation's nowhere near out of control. We need to raise rates. So you still have that argument going back and forth. You watch gold and silver go up every day. Inflation's definitely still here. Nothing's getting cheaper at all. And so you just get that argument back and forth. Meanwhile, the stock market makes new highs. Not a worry in the world right now, but here's what I think. I think it's kind of market that when it does change, it is actually going to be like no worries to way too many worries. A lot of numbers just get shuffled around the U.S. to make the other numbers work, and any bump in the road is going to send everybody careening in every direction. Job losses to non-payments on loans, and it just feels like when it does go, it's really going to go this time. And I can't shake that feeling, and I don't know what would change it, but where are you at on it? We're coming down a little bit in the interest rates very slowly, and that's where they're at. But where are you at on where you think the economy's headed?
Well, I've thought the economy's been in a bubble for at least 3 years, and I've been wrong all 3 years. So now that I'm starting to think I should change my mind
and buy the stock market,
be time. Yeah.
You let me know when you buy the micro. It doesn't matter what size you buy. You let me know when you buy it, and that'll clearly be a warning sign. But
I am the forever fade. That's for sure.
But not that a regular person doesn't know what they're doing, and I'm a regular person, but you're definitely hearing people pulling money to get out to get into crypto, pulling money out to get into stocks, of various areas, chasing the hot markets. And, that's always a pretty big warning sign. And pretty soon it's going to be taking money out to chase, cattle. That'll be another huge warning sign. But people like hot markets, and they've been running hot forever. But it's always a warning sign when everybody's brother-in-law or everybody's uncle's making a killing, and now you're going to start doing that too. Those markets tend to just completely fall apart and take everybody's money. But again, like you said, I've been thinking that's going to happen for a while now, and it doesn't. So maybe I'm the one that's wrong. Maybe I should be buying fart coin or whatever. I can't keep up with it. They make a new one every day. Whatever everybody's buying, the cool coin, Chainlink. I just threw one out there. I have known nothing about it, but that sounds cool. Maybe I should be the one buying that, and maybe I'm the guy that doesn't know what's going on in the markets. But I'd like to believe that things will come into equilibrium, and maybe we don't need all these meme coins and all this stuff. But like I say, maybe I'm just getting old and left in the dust, and I'm going to be the guy shaking an angry fist at the clouds, saying how wrong everybody is. But
obviously we are. If we would have done that 3 years ago.
Yeah, I know. It feels like a bubble. It probably is a bubble, and this one's carried on for so long. So when it finally goes, I think it's going to be bad, really bad. The gold and silver bugs say when it all falls apart, that's why I got the gold and silver. That's going to be able to buy anything. Generally, what happens is all markets go down, including gold and silver. But maybe this is a different one where everything else falls and that stays up. I don't know. All I know is we should be in metals too. We aren't talking enough about metals. Metals are incredibly dangerous because they can do like the Bitcoin. I mean, it can drop 10% on you. But there's different sizes. There's 10 ounce, there's a 33 ounce, and a 100 ounce gold contract. Maybe we should be more in metals. You just hate those markets that look easy, and then you don't participate. But the truth is, trend is your friend, and that's what's going on right now. Gold, I prefer over silver. Silver, everybody wants to like better, but the volatility in silver is killer. It goes backwards a couple bucks on you really quick. And a big silver contract, 5,000 ounces, you're going to be looking at a $10,000 loss on just backing up a little bit. Right. So I like the silver size better. Me and platinum, of course, I missed that last buy there. Yeah, the gold size. Yeah, the silver, I like the concept behind it. And there's 1,000 ounce contracts. There might even be 100 ounce. But I tend to like the smoothness of gold better than the rest. And I really like platinum. But now that's taken off, and that's no longer cheap. That thing was in the 800s just a few months ago. Now what is it, 14, 1,500?
16. 16 is
still relative to gold, very, very cheap. Right. Is that going to continue? I don't know, but it's been very strong in the metal complex.
When was the last time we saw silver at $50 though?
I don't. It's been a long time. You'll have to go. Is it the Hunt brothers? I think so.
I think it is as well.
Yeah, because when I bought it at the top last time, physical, it was 35. I think 37 topped out there and fell off. And I think that was the closest we got. And so this has to be the Hunt brothers near the Hunt Brothers high. The conspiracy guys say once it breaks 50 and then it goes to 200 like instantly, and JP Morgan's game over for the US and all that stuff. So we'll see if that happens. I don't know. I've heard that forever.
I'll need to open my safe and count my coins.
But I miss my old gold and silver bugs. People have gotten older. They've gotten away from the markets, and they're replaced by crypto bros. I mean, that's the worst trade ever. I'd rather talk silver and gold to a guy all day on the phone than talk to the crypto bros.
I'll talk to the crypto bros, so feel free to call me 218-770-6650 since John always leaves his number.
Yeah, you can talk to the crypto bros. They're fine. They got it all figured out, and the thing is, they're the ones laughing right now. I'm not, so maybe they do have it figured out.
I love it. Since I left my number, John, why don't you leave yours?
218-731-1578.
Thanks, John. I'm going to talk about the closing volatility from today. Because
those guys got to be dying. There's so many option guys that make their living at that stuff. And I mean, it's got to be grounding to a halt.